Have you ever wondered how options trading works? Well, you're in the right place to learn. Options trading is a form of derivative trading that gives you the power to control large amounts of stock for a relatively small cost. Unlike stocks where you own a piece of the company, options are contracts that give you the right, but not the obligation, to buy or sell an underlying asset at a specific price, on or before a certain date. There are two main types of options: calls and puts. A call option gives you the right to buy an asset, while a put option gives you the right to sell. The beauty of options is that you can profit from both rising and falling markets, depending on the type of option you hold. Now that we've understood what an option is, let's delve into how you can start trading options. Let's begin by understanding call options. A call option is essentially a contract that gives the holder the right, but not the obligation, to buy an underlying asset at a predetermined price within a specified time frame. This is like having a reservation at your favorite restaurant. You have the option to go, but you're not required to. Now, why would traders be interested in call options? It's simple. Traders buy call options when they believe the price of the underlying asset will increase in the near future. If the asset's price rises above the specified price in the contract, traders can buy the asset at the lower price and pocket the difference. It's like having a coupon for a product that becomes more expensive. You still get to buy it at the discounted price. So, in a nutshell, call options are all about buying when you believe the market is going up. Now, let's move on to understanding put options. Imagine you're at a marketplace. A put option is like a special ticket you buy that gives you the right, but not the obligation, to sell a particular item, say, a basket of apples, at an agreed price within a specific time period. This could be beneficial if you believe the price of apples is going to drop. By having this ticket, you could sell your apples at a higher price before the market price drops. Traders buy put options for similar reasons. They anticipate that the value of the underlying asset will decrease in the future. This could be a stock, a commodity, or even a currency. Buying a put option allows them to sell the asset at the agreed price, potentially making a profit if the market price does indeed drop. So, put options are essentially about selling when you believe the market is going down. Now that we've got a grip on call and put options, let's talk about how to actually trade them. First things first, to trade options, you need to open a trading account. This isn't as daunting as it sounds. Many brokers offer online applications that can be completed in a matter of minutes. When choosing a broker, it's crucial to consider important factors like commissions, the quality of the trading platform, customer service, and the availability of educational resources. Once you've opened your account, it's time to select the right options contract for trading. This is where your understanding of the underlying asset, the strike price, and the expiration date comes into play. The underlying asset is what the options contract is based on. It could be a stock, an index, or even a commodity. The strike price is the price at which the owner of the option can buy or sell the underlying asset. And the expiration date is simply the date when the option expires. Choosing the right contract is a bit like choosing the right pair of shoes. It needs to fit your investment goals and your risk tolerance. The more volatile the underlying asset, the riskier the option. So if you're risk averse, you might want to stick with options based on more stable assets. Now let's talk about the process of buying and selling options contracts. Buying an options contract gives you the right, but not the obligation, to buy or sell the underlying asset at the strike price before the expiration date. Selling, on the other hand, involves writing a new options contract to sell to another trader. It's important to note that each options trade comes with its own set of risks and rewards. Therefore, it's crucial to understand the potential outcomes before you make a trade. And there you have it. That's the basic process of trading options. But remember, this is just the tip of the iceberg. There's a lot more to learn about options trading. Remember, options trading is all about making informed decisions, so do your homework before you start trading. Let's quickly recap what we've learned today. We started our journey with a fundamental understanding of options trading. We discovered that it is a type of derivative financial instrument which gives traders the right, but not the obligation, to buy or sell an asset at a specified price before a certain date. We then delved into the concept of call options. We learned that purchasing a call option means you expect the price of the underlying asset to rise. Essentially, it's a bet that the stock or other asset will go up. You're buying the right to purchase that asset at a predetermined price, known as the strike price, at any time before the option's expiration date. Next, we explored put options. If you buy a put option, you're anticipating that the price of the underlying asset will fall. This gives you the right to sell the asset at the strike price before the expiration date. It's a way to potentially profit if you believe the price of the asset is headed downward. Moving on, we navigated through the process of how to trade options. We emphasized that options trading can be complex and risky, so it's crucial to understand the mechanics of it before diving in. We discussed the importance of analyzing market trends, understanding risk management, and setting a clear trading plan. We also highlighted the significance of a well-balanced portfolio and the role options can play in diversifying your investments. It's essential to remember that while options can provide opportunities for strategic investment and hedging against risk, they're not suitable for everyone due to their inherent risk. And with that, we've covered the basics of options trading. This is just the beginning of your trading journey, and there's a lot more to learn. It's crucial to continue enhancing your knowledge and to practice using virtual trading platforms or simulators before you start trading with real money. Remember, the key to successful trading lies in continuous learning and practice. Happy trading!